Welcome everyone to Relational Technical Analysis. I am Martha Stokes, CMT. As always, I am not a recommendation service company. I am an educational company. I have a Series 86 with the SEC, and all of our things are copyrighted. These are my credentials. I'm a chartered market technician and a member of the CMT Association, CEO and co-founder of TechniTrader. And I'm the author of 2 theses, Cycle Evolution Theory and Relational Technical Analysis, which I'm going to introduce to you today. In May of 2015 and in March of 2019, the Market Technician Association recognized the significance of my new theory and publication on Relational Technical Analysis. I was asked to present this new method of technical analysis to the entire membership of CMT. The new theory has been widely accepted and is being used by many professionals and retail traders, which I have taught. This theory expands the use of technical analysis in a new approach and methodology, making it easier with far more data to make more accurate decisions. I teach these to my students. Today, I will introduce you to this new way to study stock charts, which is the first process of learning to be a successful trader. Relational analysis is the evolution of chart analysis and interpretation beyond the basics of price, indicators, candlesticks, index, and trend analysis. Modern charting software offers more analytical tools, state-of-the-art hybrid indicators, and additional data which broadens the depth of analysis and the technical perspective. In other words, we are able to add more information to our charting software so that we have a faster, easier solution to finding stocks to trade that actually will make you profits. Whenever you can improve your analysis via your software tools, you will improve your ability to analyze and trade successfully, whether you are a beginner or a professional. A lot of times you people use recommended services and stocks that people tell you to buy. However, a lot of times whoever makes the profit is the one recommending it. My goal is to teach you to find your own stocks and be far more successful than using recommended stocks. Most retail traders have a simplified understanding of the stock market. The stock market and other financial markets are a complex, highly evolved ecosystem. Therefore, just applying a mathematical equations without considering the entire ecosystem will not provide the highest return on investment for trading or your long-term investments. When viewed as a living, evolving organism with continually expanding diversity, the financial markets become far more understandable. Once you understand something, you're no longer uncertain. You're no longer afraid. You don't trade with scared money. You don't gamble. You take calculated risk that gives you solid results consistently over time. Relational analysis expands the awareness of the entire financial structure for better interpretations, and it's all done in stock charts. So in order to really understand this, I'm giving you an analogy. Imagine driving at night in the fog wearing sunglasses. Your perception of what is going on driving in those conditions would be completely off. The vehicles in the fog include a log truck driver late for his delivery, a heavily loaded semi-truck, a Jaguar, a motorcycle, 2 bicyclists trying to cross traffic, and several teenagers in a car, and weary commuters who are eager to get home. With the fog and sunglasses, it is impossible to see them, judge their speed, their purpose, or emotional mood accurately as you would during the broad daylight. If you took off the sunglasses, turned on fog-piercing headlights, and focused on all the vehicles around you, your ability to successfully navigate congested areas increases. The conditions just mentioned are very similar to what technical traders experience while trading the modern automated marketplace. A lot of times you'll be trading, day trading or swing trading or momentum trading or whatever, but you don't know what's going on around you, and that's what causes losses. You can't actually see the other buyers and sellers, and without some understanding of who is buying and who is selling, risk increases. Now, why can't you see all the buyers and sellers? Seems to me that if you got different levels of screens, that you'd be able to see all the buyers and sellers. Well, 40% of all the activity does not occur on ECNs or the exchanges. It occurs in dark pools, which I'll cover later. And those are hidden orders. They're often delayed, so you can't see the largest lot transactions that are occurring during the market open and during the day. Relational analysis pierces the fog surrounding the entire market. This adds clarity to the analysis regardless of the trading instrument you choose to use, options, ETFs, stocks, bonds, whatever you wish to trade. When traders learn the technical analysis, they learn basic trend patterns, topping formations, bottom formations, and so on. You may be using Elliott wave, you may be using Fibonacci, you may be using point and pivot and reverse, pivotal points and reverse, and all these other things that you have learned. But there is more to it than that. However, that is not learning how to use that knowledge in the modern market structure. We are fully automated now. Everything is fully automated. A lot of orders just trigger on a certain price range, a certain time of day. They're not all manual as they used to be. Not only must you learn the patterns of technical analysis, you must understand the relationship between different patterns. Just learning to identify an engulfing white candle is insufficient. Where that candle forms, what candles preceded it, where it is in the overall trend are critical to your success. What is happening with price in relation to the intent of the trade, how it relates to indicators that reveal dark pool activity that is hidden that you will not see on level 2 or level 3, and HFT trigger activity is crucial to truly using technical analysis properly and successfully. Relational technical analysis takes into consideration far more data from the chart and includes more data analysis. When you have more data analysis, you have more accuracy. It just goes hand in hand. This allows the technical trader to understand who controls price, who is controlling price. Who, do you know? We'll go over that in a minute, which in turn provides superior indication of how price will behave in the near term. The new market structure. We're going to go over the new market structure, which most of you do not know unless you are my students. The Dow theory, and all of you have probably heard this. If you haven't, I'm going to go through it very quickly. Dow wrote this theory in 1890. He said there were 3 levels of market participants. Informed buyers, which were the banks, wealthy individuals, and corporations, accounted for 50% of the market activity. They knew what they were doing. They bought in low and they sold high. Then you had your average investors of that era who came in on the dip, buy on the dip, and then got in halfway up the trend. And then you had your uninformed investors who accounted for 10% of the investment opportunities in those days, and they came in at the top and always lost money. And even nowadays, I see odd lots coming into the market now, buying high, and they're going to lose money. So here's the cycle of market participants of today. We have buy-side institutions. I am a retired member of the buy-side institutions. I know them best because was a buy-side institution. The buy-side institutions are your mutual funds, your derivatives developers like BlackRock, State Street, all of your mutual funds, all the people who are fiduciarily responsible for the vast wealth of the United States and globally. The buy-side institutions control between 80 and 120 trillion dollars worldwide in assets under management. The sell-side institutions are your big banks, hedge funds, and so on and so forth. They get in at the bottom because they are buying at the best prices. Wealthy families and individuals and family trusts also get in low because they know all about business and they know why stocks move the way they do. Independent pro traders are very active in the market right now, and they are a big part of the professional side. They work for the buy-side institutions, they work for the sell-side institutions, and they also work independently. So proprietary pro traders are part of the buy-side or sell-side. The independents are working for themselves or for a company. Corporations, we have had over $1 trillion in buybacks last year, and we will supersede that way beyond that this year. Corporations have been buying back their shares of stock. That is a major change that has occurred in the last couple of years. It alters the trends entirely, and you need to know when they're buying back and when they're not, because they can really move price with momentum, and you can take advantage of it. High-frequency trading firms are very active in the market. They are mostly early morning before the market opens. They'll check to see on the exchanges and all the level 2s what retail traders are buying and selling, what smaller funds are buying and selling, and they will front run you every time. Big gaps, big runs, that's an HFT. Smaller funds, foreign funds, sovereign funds, and nonprofits. These are less educated funds managers. They are part of the large lot or the professional side, but they trade like the retail crowd. That group of professionals controls 80% of all the activity, and 40% is controlled by the buy-side institutions on dark pools. Retail technical traders, which are, I'm hoping most of you are, individual small lot investors and odd lot investors account for 20%, and that's rapidly declining to 15% this year. It will even go lower at times because there is more dominance on the professional side than ever before. So on the downside, a lot of people think everybody sells shorts, but only 3 of these groups actually sell short. High-frequency traders sell short, independent proprietary pro traders sell short, and retail technical traders sell short. Everyone else does not sell short. The buy-side and the sell-side institutions are bargain hunting, and they will wait until the capitulation of the individual small lot investors and odd lot investors and the capitulation of the smaller funds, retail traders. You need to learn both sides of the market because you will need to be able to trade the bear markets when they arrive. Relational technical analysis includes technical analysis that you have learned, fundamental analysis in a chart form, risk analysis in a chart form, and quantitative analysis applied in a chart form. All of this data is now included in charting software, enabling you to do a complete analysis of a stock and the company all at once in a very simplified format that you will be able to apply within a few minutes. This provides invaluable analysis, speeds up the stock pick selection, and helps you focus on the best stocks to trade, eliminating inferior stocks and eliminating the need to use someone else's recommended stocks, which they're making a profit on. With relational technical analysis, traders are using far more information in a simplified trading process that generates higher profits with less time than traditional technical analysis. I know a lot of day traders come to me and they tell me that they're spending 8 to 10 hours a day, 5 days a week, or 6 days a week trying to get sufficient money from day trading. Relational analysis. These 4 distinctly different forms of data analysis can now all be used within charting software, streamlining the entire process. You have more data. You have more information. You're going to makes the decisions of what stocks to trade easier. You can front run the HFTs instead of them front running you. There's a lot of things that you can learn. With why fundamental analysis? Technical traders have often been told, oh, you don't need fundamental analysis. Don't worry about it. 80% of the market participants still use fundamentals and rarely use technical analysis. So if you don't have that in your stock charts, you don't know what they're doing. Modern charting software now has fundamental line indicators incorporated into the charts with technical indicators. It's easy to see what's going on. Incorporating institutional ownership percentages and buy-side versus sell-side institutional activity as an example can be a huge benefit. You want to be trading with the buy-side institutions, the dark pools. Some of you may have never heard that term before, but the dark pools control a vast amount of every transaction that occurs. They're huge liquidity draws or suppliers at times. Quantitative analysis can be incorporated into scans, sorts, and market analysis in order to refine stock analysis. Risk analysis considers not just stop loss placement, which you should never, ever use an 8 or 10% stop loss placement on your charts. You know why? Because the HFTs know this, and that is why sometimes we have these huge drawdown days that seem to come out of nowhere. Those stops all trigger at once, and the HFTs take advantage of it. But also run gain or target gain potential is important in risk analysis. That all comes from the charts. If you want to buy into a stock and you see the dark pools have been accumulating it, and you know that the dark pools are going to suddenly let everybody know they've been accumulating it, so pro traders will get in, HFTs traders will get in, you want to get in before it moves. You want to get into that big long run or that gap ahead of time instead of chasing it like so many day traders do. Then you need to be able to calculate the run gain or target gain potential during the time that you're going to be holding the trade. How long are you going to be holding the trade? You should know before you place an order how much point gain potential there is based on support and resistance and risk, who's going to be moving that price so you know how far it's going to go, and how long are you going to hold that trade. If you know these things, you will be far more profitable. Now, this is one of the fundamental indicators. It's the percentage of shares held by institutions. This stock has been running up, and we've had a lot of good, strong up days on this, but look what has happened recently. As the stock is moving up, institutions have actually been rotating out of the stock. This means that if you continue to trade this and running up, at some point you would suddenly experience a huge down day with a massive loss because they have been slowly rotating out of the stock, lowering the percentage of shares held by institutions. That puts pressure to the downside that is not visible in the price or indicators. So that is a high risk entry point that you would not want to do. These are some of the fundamental line indicators for charts. If you want a full list, I can provide that later. Risk analysis is part of the chart analysis. And you need to understand, you can use Bollinger Bands, you can use Elliott Wave, you can use Fibonacci, you can use Gann, you can use anything you want. Bollinger Bands. But these do not tell you the precise direction the stock is going to take. You need other information that will help you understand what is going on in that trading range before it breaks to the downside. And huge gaps, so you would be in here early, and as it gaps down, you can make substantial profits. This point gain was from 179 down to 169. So there's a lot of things that you can learn by studying the new charts and the new relational technical analysis to get the information from the charts so that you can find the best opportunities before the HFTs run it up or down. Quants and their impact on price action. This is very, very important. In the past, quantitative analysts wrote algorithms primarily for the sell-side institutions, banks, HFTs, and hedge funds. However, the buy-side institutions now use quantitative analysis for their buying and selling, so they're basing their portfolios on quantitative analysis. This can be incorporated into your stock charts. Technical traders can now employ some form of this type of analytics in scans, sorts, and strategies using the new charting software. So it just makes it easy. You want to find some stocks that have potential before it actually moves. You don't want to be chasing stocks. You don't want to be trying to get into a stock as the HFT is driving it upward in the morning. You want to get in and just ride it up and enjoy the ride. You need to have these scans and sorts based on quantitative analysis. In doing so, technical traders will improve their trading process and simplify it. Too many times your process is too complicated, or you're depending on recommendation services that do not provide the best entries. Market condition analysis is an example of one such application that my students use on a regular basis. I use it every day. It is far more accurate than just using major indices value changes to determine the trend and conditions. The indexes do not tell you the broad base of market activity, what's happening on the underlying stocks, the non-component stocks of indexes. There are over almost 6,000 stocks that you can trade and several thousand ETFs and other derivatives. You have to know what that group of stocks is doing as opposed to just the indexes. The indexes don't tell you that. They only tell you a small group of stocks. So market condition analysis is my proprietary professional relational technical analysis of the conditions present at any given time. And this is critically important. Do you know what market condition we have right now? I'll tell you in a minute. It includes quantitative formulas, which reveal whether dark pools are active or not and whether the market is entering a momentum mode, a platforming mode, is insipid, or a void. This past week, it was a void 3 times. That made it very difficult to trade and make profits. Voids are becoming more common nowadays as so many of the giant lot institutions control when their orders trigger. They don't just put them in the queues and hope that it fires off. They hit precisely at a precise time at a precise penny. Can you do that? I'll show you. Market voids are extremely high-risk conditions which are not visible in index action, news, or other market indicators due to the type of order and venues giant funds now use. The dark pools are not visible to you. They're invisible. So we have the market conditions. A momentum buy-side market condition. We have a momentum sell-side market condition. institutional activity market condition, bottoming stock market condition, consolidating stocks market condition, range bound market condition, and platform market condition. Each of these conditions are very different and unique, and when you learn them, you'll be able to make more money. By quickly comparing the number of stock charts in each of these above scans, I can quickly know what's going on and plan and prepare for the next trading day. Is there going to be momentum or not? Is the market going to go up or down? You can't rely on news, and it's very risky to rely on recommendations because they're not always aware of the market condition. What is going on in the underlying stocks? What are the buy-side institutions buying or selling? Where are they? From there, it is simply a matter of using custom scans designed for that market condition to find stocks. It pulls up a small group of lists, and there you go. This incorporates a type of quantitative analysis into the trading process in a simple, fast, and highly reliable method. So you're trading like the big boys instead of the retail crowd. These are the scans. This is an example from yesterday. We can see that we have a low number of momentum buys. We have a very high number of momentum sells. The institutional activity is very, very light. Avoid. Bottoming scans, there are very few bottoming scans. There are many stocks that are consolidating. There are many stocks that are turning in their range-bound position because we're in a trading range market condition heading into a bear, and we have very few platforms developing. All this can be done in just a quick glance, calculating the numbers, and you know what market condition you have. It's very simple, very easy. All my students use it. So the 6 market conditions are bottoming, platform, moderately trending, up or down. Very common to see this. Velocity up or down, very short term. Velocities are very limited in time span. Trading range, which we're in right now, and topping. 4 of these conditions are sideways patterns. Bottoming, platform, trading range, and topping are sideways. Only moderately trending or velocity actually trend up or down. Each sideways price action is different and unique to that particular market condition. So you need scans that find bottoms when you're in a bottoming market. You need to use scans that give you stocks to use in a trading range market. In a moderately trending market, it's pretty easy to trade, but we're not in the moderately trending market right now. The automated marketplace trends sideways about 70% of the time, and you Elliott Wave and Fibonacci and all those probably know that. Moderately trending and velocity are trending markets for both up or down. And with speculation, with HFTs, these trends can go far further than the normal technical analysis would tell you. You'll blast right out of your stochastics, you'll blast right out of your MACD because of speculation. Downside price action is very different from the upside due to the lower number of market participant groups actively trading the downside market or selling short on the short-term basis. So it is quite different. It is not the reverse of the uptrend. The uptrend takes many years to form. The downtrend happens within a year, year and a half. So market condition tells you who is in control of price, what technical patterns are prevalent and reliable, how price will behave at resistance and support. In a trading range, resistance and support becomes very prominent. In a moderately trending a velocity market, they'll blast right through that resistance. You need to know this. What trading styles work best in what market condition? What indicators to use? You will slightly have to modify your indicators if you're trading velocity market versus trading a trading range or platform market. The inherent risk in trading specific styles in a specific market condition. What trendline patterns are most common? A lot of you don't know trendline patterns, but there are several different types of trendline patterns that tell you how the price will behave next. Those of you using Elliott Wave have some idea of that, but there's more to it than that. What entry and exit signals are most reliable? Oh, you see this great engulfing white. Wow, I'm going to buy this stock. It's going to go up like a rocket. And it reverses because you're in a trading range market and you don't know that. The strength of the price and volume patterns. Market condition analysis tells you how and when to trade, who is controlling price of the 9 market participants, what to expect in near-term price action, where to find excellent picks, how to enter, and when to exit. It gives you everything you need to know. Market condition analysis is a roadmap on which to market participants are actively trading, which are sidelined or waiting, and where we are in the overall long-term trend, intermediate-term trend, and short-term trends. So you have all this information in 6 simple scans. Then you just pick the scans that are appropriate for your trading style, you find the stocks, and you're ready to trade. Why each market participant group impacts price differently. A lot of people say, well, why aren't they not all trading the same? Why is there any difference? Why is this so important? So here we go. You need to learn why and how each of the 9 market participant groups affect price and volume. You must understand the wide disparity between the groups in terms of venues that they trade on, order types they use, speed of their execution, access to information you do not have because they buy it. You get it for free. Lot sizes they use and intent of the trade. Over the past few years, the financial markets, especially the stock market, have fractured into a multi-venue structure that has never existed before. Relational technical analysis makes it easy to recognize each market participant group's footprints on the charts because of how they trade. If you know how they trade, you'll go, oh, that's a dark pool. Oh, those are professional traders. That's a buyback. That's corporations. And that makes all the difference in understanding what's going on. Dark pools, order sizes, are institutions buying tens of millions of shares of stock over a long period of time. Their typical lot size is 100,000 shares to 1 million, which are automated orders that trigger over many weeks of time on time and price values. Smaller funds share lots range from 10,000 to 50,000 and are automated to trigger on volume, VWAP, volume weighted at price. So anytime there's a volume surge by HFTs, the smaller funds are buying like crazy into an over-speculated price. HFTs trade 60,000 to 90,000 times per minute. Hence, their relatively small lots on the millisecond become large lots on the minute scale you are using. HFTs use a variety of algorithms that trigger automatically. They're all automated, it's fully automated. HFTs front-run retail orders using price because the SEC requires that your broker lights all of your orders before filling them. So the HFTs know what you're doing. Anytime you're in a chat room, anytime you're going on, they know. Professional traders typically use 10,000 share lots and up, often 50,000 is their high end, depending on their capital reserve provided by their firm. Corporations trade 50,000 share lots when in buyback mode. This is done by the bank of record, so it's the sell-side institutions performing this operation for corporations, not the corporations. They buy back millions to billions of shares of their own stock over time. Apple has bought back billions and billions. Retail traders trade on an average of 100 to 5,000 share lots. Retail investors buy 100 to 1,000 share lots. Odd lot investors buy less than 100 shares. So you can see that the weighting of the lot sizes impacts price considerably. There are many types of orders. Dark pools use various types of TWAP orders which allow for maximum control of the entry price. They control price. They don't move price, they control it. So when you see very controlled, very tight price action on your chart, that is dark pool activity. HFTs use algorithms that trigger on retail news, arbitrage, and popular retail indicators such as MACD, and anytime they see cluster orders from the retail brokers. Smaller funds use VWAPs, which is often automated, triggering on HFT volume. So smaller funds chase the HFTs and lose money. Professional traders seldom use limit orders. That is a falsehood that still persists today. They have so many sophisticated orders, and they're often multi-legged, 10 legs on one order in a variable areas of different financial markets. So they're extremely sophisticated. They're not using limit orders, folks. So anybody who tells you they use limit orders, they don't know what they're talking about. Retail orders use limit orders, which often result in whipsaw action or getting a poor fill. Small investors use market orders or at market, which are usually filled from their broker inventories. Brokers fill 90% of their orders. Your retail broker fills 90% of all their orders they receive. Never gets to the exchanges. Never gets out there. Liquidity makers and takers. It is critical to know which market participant groups increase liquidity. You need to know which market participant groups lower liquidity. When liquidity falls, the relationship between supply and demand shifts, forcing prices up as the supply of shares currently offered out diminishes. The opposite occurs when there are large lots reducing inventories in ETF trusts and mutual funds. When huge quantities of stock are being offered for sale, this forces price down. With the fully automated market, illiquidity has become a major problem for day traders and large lot traders. It's a big problem. A lot of times during the day, there's a lot of illiquidity. Buy-side institutions are liquidity takers as long-term investors. Sell-side institutions make and take liquidity. HFTs are considered liquidity makers. The debate about their role is ongoing. The SEC classifies HFTs as maker-takers as many earn high incomes from exchange rebate programs to make liquidity. Professional traders are liquidity makers, trading on the short term. Small lot funds are takers, as most are long-term investors. Retail traders and investors are minor takers or makers that have minimal to no impact on overall liquidity. There are currently in the U.S. market, 13 stock exchanges where HFTs, smaller funds, retail traders, and small lot investors trade, but retail traders never get to the exchanges. 40 or more alternative trading systems for dark pools, twilight pools, where buy-side institutions do most of their transactions, hidden from the retail trader, even if you use level 2 or level 3. There are also electronic communication networks, ECNs, which are level 2 and level 3. In addition, most U.S. retail online brokers internalize their customer orders, which is a loosely connected multi-company venue all on its own. The SEC considers the retail brokers, the top 6 retail brokers, to be a consortium dark pool that trades amongst themselves. HFT's low latency order execution systems have the fastest execution, 3,000 to 6,000 trades per second. That's about all they're going to get. SEC data from Midas shows that dark pools have the slowest execution of about 10 minutes to fill their large lot order. Dark pools often must wait for liquidity to appear, gathering up numerous small lots to fill their large lot orders. The retail side average is less than 1 minute, usually can be a little bit longer. Each group's order execution occurs at a different speed, so somebody can front run you because you're on the minute scale, and that's as fast as you're allowed to trade. Dark pools and twilight pool activity has risen to almost 40% of the total consolidated ticker tape volume per day. So all that activity you can't see. Dark pools are used by the giant buy-side institutions who control $80 to $120 trillion in assets worldwide. Dark pools provide off-exchange OTC orders on alternative trading platforms you are not allowed to see. This provides 2 benefits to the giant fund. The ability to control their impact on price when buying or selling stocks. They do not move price much. Avoiding HFT front running that is common in the stock exchanges, the dark pools controlled bracketed orders trigger automatically over time, creating a consistent price action that you can see on your charts if you know what you're looking for. Only relational technical analysis reveals their activity. So we have dark pool activity going on and HFTs driving price up. The dark pools will let everyone know once they've accumulated the stock at a certain price that they have been buying it, and then HFTs will try to front run and move ahead. So a lot of you are getting in with HFT activity, not dark pools. You want to get in with the dark pools so you make more money. Retail technical traders do have a decided advantage. You are lucky. Since institutional algorithms produce computer-generated order flow over extended periods of time, their patterns and price range are precise and repeat. Repetitive price action by dark pools allows the technician to prepare for sudden momentum moves. This gives technical traders the edge to be able to anticipate HFT and pro trader activity, as these 2 market participant groups tend to chase the dark pools. So you have dark pool activity, pro trader, HFT activity, small funds, and retail traders. This is a millisecond scale chart, by the way. Smaller funds also tend to accidentally chase HFTs as they typically use VWAP orders, assuming that they are chasing dark pools. Many technical trading systems use either MACD or stochastics for formula trading using a rather primitive and simplistic algorithm. These popular indicators create inherent risk in today's electronic order processing marketplace. High-frequency trading firms use these indicator formulas in order to find anomalies in order flow. The intent is to front-run cluster orders, and they do it all the time. When cluster orders are identified by the QA formula, it triggers HFT millisecond trades that can move price before the trading system orders are filled. This is a primary cause of whipsaw action when using technical systems, especially intraday or day trading. Normal flow is at market, limit order, dark pool, so it's all over the place. Cluster orders are because everybody's using this one recommendation service or whatever, and they cluster the orders together. HFTs go, aha! They front run you because they can push their orders ahead in the queues, and then they start selling into your buying. Dark pools use a very controlled bracketed order within a specific price range, usually in bottoms and platforms. Shifted sentiment is seen in both candlestick patterns and how the short-term bottom is formed in a shifted sentiment pattern and hybrid indicators. We use hybrid indicators because they work very well. HFTs search for dark pools, giant share lots hidden on ATS venues. They can't see them either. Often the HFT automated trigger order accidentally trades against the dark pool, causing a gap down, drops into the buy zone, and automatically this creates a temporary sell down, which reverses the next day. Volatile price action is caused by HFTs, not dark pools. Anybody who says that dark pools cause volatility doesn't know what they're talking about. The shift of sentiment occurs prior to the HFT front run. Candlesticks have frequent resting day patterns. So you have tighter formation, that's the dark pool buying activity, shift of sentiment action. We have selling short down here, and we have pro traders getting in here and front running before the HFTs take off. HFTs are just the opposite of dark pools in terms of price action and candlestick pattern. HFTs are trying to force price to move quickly and in a large volatile or velocity intraday patterns within 1 to 2 minutes. Gaps are far more prevalent in recent years than in prior decades, and they happen at market open. Huge gaps and extraordinarily long candles are the primary candlestick patterns from HFTs, not dark pools. Smaller funds, as well as retail traders and investors, often chase HFT activity without realizing it. HFT candles are typically one-day events and often do not change the trend. So you're being told, oh, buy into this. Oh, that's going to move up. Nah, because everybody's going to be selling. Pro traders are already in this, and they'll be selling against your buying. Don't do it. Okay, relational analysis uses additional indicators incorporated into the chart analysis. This speeds up the process. Hybrid indicators are a new type of indicator which employs more data into the formula in a more complex method that is easy to read. Green light says they're accumulating. Red says they're distributing. It's very easy to follow. Large lot activity. This is volume. This is the total number of shares exchanging hands. This is were those exchanging hands on more large lots on the buy side, or were they on the sell side? In this instance, it was on the buy side. The use of uptick versus downtick analysis, small lot versus large lot activity provides leading indicators that are superior to the old style indicators in the modern automated marketplace. These are the indicators you need to add to your MACD, add to your stochastics. Since more of the most important market participants use off-exchange venues, more complex orders and transactions that can be delayed until end of day or after market close, revealing their activity requires new types of indicators. And so include these in your indicator toolkit. So we can see dark pools are accumulating, and then after they let everybody know, it takes off, and we can see quiet accumulation before it takes off occurring down here. So let's summarize. Relational technical analysis expands on traditional technical analysis, incorporating more information for more reliable results right in your charts, which makes it easy and simple. This game-changing approach to chart and market analysis is taught exclusively through the TechniTrader's Methodology Essentials courses. Relational analysis works for all financial market instruments. However, the market participant cycle varies for each market. So if you're trading Forex, you need to understand that cycle of market participants. Market structure changes have made it necessary to not only study index activity, but also the activity of the dark pools. The buy-side institution's activity is hidden from you and the HFTs and anybody trading on the exchanges. Tracking the giant funds is simple with a relational technical analysis. These large lot investors leave distinct footprints on the chart, and they're easy to see. Front running by HFTs can be avoided or used to your advantage when you learn this unique form of chart study. RTA shows you where HFTs are most likely to trigger next on short-term trades. Accepting newer concepts can at times be intimidating, but all technical traders need to adapt in order to succeed in the evolving market structure, or you'll continually have losses. We have our website is TechniTrader.com. We've been doing this for over 20 years. We have a special going on right now. I suggest that you peruse our website and then go over to the stock courses if you see something. We have beginners, experienced, and traders. Different courses. Elite Traders is our professional package. If any of you are small funds managers or professionals, this is for our professionals. For those of you who have over 5 years of experience, this is your course, and anything on 2 to 5 years or brand new starting beginning traders, you would start here. We have a lot of other courses I've constructed over 55 courses over the past 20 years. I have the broadest base of courses available anywhere. So if you want to swing trade, options trade, whatever, that's available as a CMT. The SEC recognizes this as the Series 86. So I am accredited, and I have plenty of information that you can learn and prosper from. It's a good idea to make sure that anyone you take a course from has some SEC credentials. Thank you for joining me today. I'm Martha Stokes, and please visit our website.